Hi everyone, in this video we will be going over A-Level Accounting 2022 February-March Paper 3 to question number 1. This is the structured paper 3 which consists of 6 questions. Each of them will be of 25 marks and we're also given a time limit of 3 hours, which means that ideally we should be spending about 30 minutes in order to solve each question. And in this video as well, we will be attempting to solve this question number 2 under 30 minutes. So without any further delay, let's get started. X Limited provided the following information relating to its non-current assets at 1st January 2021. So we're given the cost, accumulated depreciation and net book value for building, plant and machinery and motor vehicle. Then the following transactions took place during the year ended 31st December 2021. We're told that the building, which has a useful life of 20 years, was purchased on 1st January 2016. It was then revalued to 750,000 on 1st January 2021. Alright, then a new machine was purchased on 1st March 2021, costing 200,000. Other related costs were also incurred as follows. So we're given the installation cost, delivery cost, pre-production testing, repair and maintenance for a 5-year contract. Then, according to our third information, the motor vehicle is a diesel lorry which was bought on 1st January 2019 and it has an estimated useful life of 5 years with no residual value. A recent government environmental policy urged X Limited to review the value of this lorry, and then further information at 31st December 2021 relating to the lorry was as follows. So we're given the estimated value in use as well as the expected selling price before incurring selling costs of 4,000. Finally, we are given the depreciation policy of X Limited. Okay. And we are also told that a full year's depreciation is charged in the year of purchase. Let's have a look at the first question. We need to explain why a business may need to impair its non-current assets. Okay, so the very first reason why a business may need to impair its non-current asset would be according to the prudence concept. And this is done so that the value of the assets is not overstated. And the next reason could be to ensure that the financial statements show a true and fair view. And businesses also need to impair its non-current assets according to IAS 36, which deals with impairment of assets. And this is done to ensure that the carrying amount of assets does not exceed their recoverable amount. So let's write those reasons down. Okay, so the first one is prudence concept. So that the value of the assets are not overstated. And this then shows that the financial statements show a true and fair view. So let's write that down as well. So that the financial statements show a true and fair view. And the third reason was due to IAS 36, which deals with impairment of assets. And this is done to ensure that the carrying amount of asset does not exceed their recoverable amount. Alright, this concludes the first part of this question. We can now move towards the second one. We now need to explain to what extent the value of the diesel lorry is to be impaired. We need to support our answer with calculations. So let's have a look above at our given additional information. We talked about diesel lorry in the third one. So let's have a look again. The motor vehicle is a diesel lorry which was bought on 1st January 2019. It then has an estimated useful life of 5 years with no residual value. And we're also given that the depreciation policy for motor vehicle is a straight line method, which means that the depreciation charge per year is going to remain the same for each year, and that is just going to be our cost minus our residual value divided by estimated useful life. Alright, then a recent government environmental policy urged X Limited to review the value of this lorry, and further information at 31st December 2021 relating to the lorry was as follows. We are given the estimated value in use and the estimated selling price before incurring selling cost of 4,000. So the very first thing that we need to figure out in cases of impairment would be the carrying amount. And carrying amount, I'm just going to write it down. So the carrying amount is just going to be the difference of our original cost and the accumulated depreciation. And in this case, we can see that our lorry was bought on 1st January 2019, and we need to figure out its value at the date of 31st December 2021, which means that the accumulated depreciation will be the depreciation charges for the year 2019, 2020, and 2021, which is the depreciation charge for 3 years, right? And let's have a look at our cost. So the cost of the motor vehicle, we can see right here, is 60,000, right? And we have already figured out that the formula for depreciation will be cost minus residual value divided by estimated useful life. So let's substitute the value for cost, that's 60,000. And we were also told that there is no residual value, which means that the residual value is going to be 0. And then we divide it by our estimated useful life, which is given to be 5 years. So this gives the depreciation charge per year for the motor vehicle to be 12,000. Now we have the original cost of 60,000, and the accumulated depreciation is just going to be the depreciation charge for 3 years. So that will be depreciation charge for 1 year times 3. And this gives the carrying amount of the motor vehicle to have the value of 24,000 at the date of 31st December 2021. Now we are also given the estimated value in use, right? So the next thing, in order to figure out whether there needs to be an impairment, is to figure out our fair value. So I'm just going to write down the formula for fair value right here. Fair value is just going to be our expected selling price after selling costs. And in this case, we can see that our expected selling price is given to be 21,000, but this also includes our selling cost, right? This is before incurring selling costs. So we just need to subtract this selling cost from our expected selling price in order to figure out the fair value. That's going to be 21,000 minus 4,000, which results in the value of 17,000. Then we are already given the information regarding estimated value in use, right? Let's write it down. So the value in use is just going to be 18,500. Then we need to compare our fair value and value in use in order to figure out the recoverable amount. And recoverable amount is just going to be higher of the fair value and value in use. I'm just going to write it down right here. Higher of the fair value and value in use. And in this case, we can see that our fair value is 17,000, whereas the value in use is 18,500, which means that our recoverable amount is going to be equal to the value in use, and that is 18,500. Then the next step would be to compare our carrying amount with the recoverable amount. In this case, we can see that the carrying amount is 24,000, whereas the recoverable amount is 18,500. And impairment should be done if the carrying amount is greater than the recoverable amount, right? So there exists an impairment loss as the carrying amount is higher than the recoverable amount. And let's figure out this impairment loss. That is just going to be the difference between carrying amount and recoverable amount, which in this case will be 24,000, minus 18,500, which results in the value of 5,500. So this will be our answer for the second part of this question. I'm just going to write all of this down and explain step by step again. So let's do that. The very first step would be to calculate our carrying amount. So carrying amount, and this carrying amount is at the date of 31st December 2021. And this is just going to be original cost minus accumulated depreciation. And we had the original cost of 60,000. We figured out the accumulated depreciation to be 12,000 times 3, which gave the carrying amount at 31st December to have the value of 24,000. Then the next step was to figure out our fair value. And fair value was the expected selling price, or this is the expected market value after selling costs. And in this case, we were given the expected selling price to be 21,000 before incurring any of the selling costs of 4,000. So we just subtract that amount and get our fair value of 17,000. All right. Then the next step was we were already given the value in use. So the value in use was given to be 18,500. Then the next step would be to figure out the recoverable amount. And this is just going to be higher of fair value or value in use. And in this case, we can clearly see that our value in use has a higher amount. So that's going to be the recoverable amount. So 18,500. Now the final step would be to compare our carrying amount to the recoverable amount in order to figure out whether there needs to be an impairment loss. And in this case, there exists an impairment loss as the carrying amount is higher than the recoverable amount. Let's figure out our impairment loss. That is just going to be the difference between carrying amount and the recoverable amount. Carrying amount was 24,000, whereas the recoverable amount was 18,500, and this leads to an impairment loss of 5,500. This concludes the second part of this question. We can now move towards the third one. We now need to prepare the non-current assets schedule in a format suitable for inclusion in the notes to the financial statements for the year ended 31st December 2021, and we do not require a total column. Okay, so we have three different assets. The very first one was motor vehicle. I'm just going to write it down. We were given plant and machinery. And we were given building. So a non-current assets schedule in a format which will be suitable for inclusion in the notes in the financial statements for the year will have three different sections. So the very first one will deal with our costs. The second section will deal with the accumulated depreciation, whereas the final section will deal with the net book value or the carrying amount. So let's start with our cost or valuation. So the format for this section or all the other sections, we always start with the opening balance. So that is at the date of 1st January 2021. Then we add all of the new purchases or additions. So that's going to be plus additions. then we adjust the revaluation. So the revaluation could be added or subtracted based on whether there is going to be a revaluation upwards or a revaluation downwards. So if there is revaluation upwards, we add that amount, and if there is revaluation downwards, we subtract that amount. So this is going to be for revaluation. Then we also need to deal with the impairments. And impairments are the losses, right, which needs to be subtracted. And we also need to subtract the disposals, but in this question, I don't think we were given any sort of disposals, so I'm not going to write that down. But you guys should also remember that disposals are to be adjusted in the cost. And this will give the value at our closing date, which will be at the 31st December 2021. Okay, let's substitute the cost for building, plant and machinery, and motor vehicles. Let's have a look above. We can see that the cost for building was 600,000, for plant and machinery it was 400,000, and motor vehicle it was 60,000. So let's write these three amounts. Again, let's have a look above for additions. And I think we are given new purchases for plant and machinery. Okay, so the first one, this deals with revaluation. All right, let's have a look at this. The building, which has a useful life of 20 years, was purchased on 1st January 2016, and it was revalued to 750,000 on 1st January 2021. This just means that now the total cost of the building should be 750,000 at the ending date. So let's write that down. That's going to be at the ending date. Now, if we need to bring the amount of 600,000 to 750,000, we just need to adjust the difference between these amount as our revaluation. So the difference is just going to be 750,000 minus 600,000, which means that the revaluation upwards will be of 150,000. Let's add that amount. Now let's have a look at our second additional information. We're told that a new machine was purchased. So this is a new addition that we need to adjust in the cost section of our non-current assets schedule. And it had the cost of 200,000, and other related costs were also incurred. So these costs are given so that we can figure out which one of them belongs to our capital expenditure and which one of them are revenue expenditure. And if it is a capital expenditure, we need to include it in our cost. So we can easily figure out whether the cost is a capital one or a revenue one by figuring out whether it is a recurring expense or a non-recurring one. If it is a non-recurring expense, then it is definitely a capital expenditure or a one-time expenditure. And if it is a recurring one, which means that it needs to occur frequently in the future as well, those will be categorized as revenue expenditure. So the very first one is installation, and installation needs to be done only once. It does not need to be done time and again, which means that this is a non-recurring expense. So we can categorize it under our capital expenditure. The second one is delivery. Again, delivery does not need to be time and again. Once the machine is delivered, it is always going to be at our factory, right? So it is also a non-recurring expense or a one-time expense, which means that this should be included in our capital expenditure. Then the third one we have is pre-production testing, and this is to be done before production of any sort of goods, right? Which means that it only needs to be done once. After the production has started, it cannot be termed as pre-production testing, which means that this will also be categorized as our capital expenditure. And the final one is repair and maintenance. Repair and maintenance is something that needs to be done time and again, which means that this is a recurring expense. So this should be categorized under our revenue expenditure. And like I said before, all of the capital expenditure should also be included in our cost. So let's figure out the total cost. We start with what's given, so that's 200,000. Then we add all of our capital expenditure. So the very first one is installation cost of 11,000. Then we have delivery cost of 8,000. Then we have our pre-production testing, so that's of 5,000. And this gives the total cost for this new machinery purchased on 1st March 2021 to have the amount of 224,000. Let's include this in our non-current assets schedule. So we have additions of 224,000. All right, let's move towards the next one. And the third information dealt with an impairment loss. And we already figured out that there exists an impairment loss of 5,500. Now remember that the correct step is not to subtract this amount of 5,500. What we need is for the ending date value to be equal to our recoverable amount. So that is 18,500, right? This is the value that we require at the date of 31st December 2021. So let's write that down. So that's going to be 18,500, which means that the difference between our cost at 1st January 2021 and the cost at 31st December 2021 will now act as our impairment loss, right? So let's figure out that amount. That's going to be 60,000 minus 18,500, which results in 41,500. So we just need to subtract this amount as our impairment loss. Let's write it down. All right, now let's figure out the closing date balance for plant and machinery. That is just going to be the sum of these two amounts, 400,000 plus 224,000, which results in 624,000. All right, now the first section of our non-current asset schedule is completed. We now move towards the second one, which deals with accumulated depreciation. Let's write it down. And again, we start with the accumulated depreciation at our opening date. So that's going to be 1st January 2021. Then the next step would be to adjust for revaluation. And whenever there is revaluation upwards, such as in this case, we need to subtract all of the previously charged depreciation or the previously charged accumulated depreciation. So I'm just going to subtract it. This is the revaluation, and we subtract the accumulated depreciation right here. Then the next step would be to adjust our impairment as well. And after adjusting for impairment, like in this case, we now require our closing date accumulated depreciation to be 0. So this impairment is also going to be a subtraction of all of the accumulated depreciation as well as the depreciation charge for the year. Then we also need to add the depreciation charge for the year. In order to get the closing date balance. So that's 31st December 2021. Okay, let's write down our opening date balances of accumulated depreciation. It was given in the above information. So we have the accumulated depreciation to be 150,000, 160,000, and 24,000 respectively. Let's write it down. So that is 150,000, 160,000, and 24,000. Okay, first of all, we had revaluation of building, and like I said before, during times of revaluation, we need to subtract the entire accumulated depreciation. So I'm just going to subtract 150,000. Then we need to charge the depreciation for this year. Let's have a look above and figure out the charge for the year for building. All right, we can see that the building, which had a useful life of 20 years, was purchased on 1st January 2016. But since it is now being revalued at the date of 1st January 2021, all right, so this is 2016, 17, 18, 19, 20, and then 21. So the revaluation is being done at this particular date, which means that these 5 years have already been passed. So now the remaining useful life is going to be 20 minus 5, which is 15 years, right? So now our estimated useful life is going to be 15 years at the date of 1st January 2021. And we have our revaluation amount of 750,000, which now acts as our cost. And we are given that the basis for depreciation for building is straight line method, which means that we will be utilizing the same formula of cost minus residual value divided by estimated useful life. Again, we are not given any sort of residual value for building, which means that we consider it to be 0. So the depreciation charge is just going to be the cost, which is the revalued amount of 750,000. We don't have any residual value, so that's going to be 0. Then divided by our estimated useful life, which we just figured out to be 15 years. And this gives the depreciation charge for a year to be 50,000. Let's write this down in our non-current assets schedule. So that will be 50,000, which means that at the date of 31st December 2021, the accumulated depreciation for building will be the sum of these three amounts, which result in 50,000. Now let's move towards our plant and machinery. There was new addition, so we also need to incorporate that while figuring out the charge for the year. So the basis for depreciation for plant and machinery is given to be reducing balance method at an annual rate of 25%, which means that we need to apply this rate of 25% to the net book value. Let's do that. So the depreciation for plant and machinery is just going to be the net book value of previously owned plant and machinery, which was given to be 240,000. Then we also have new purchases, and when there is new addition, the cost will be equal to the net book value. So the cost was of 224,000. We just need to add that and then multiply it with the rate of 25%, which we can write down as 0.25, which results in the depreciation charge for the year to be 116,000. Let's write this down in our schedule of non-current assets. So that will be 116,000, which means that the total accumulated depreciation at our ending date would be the sum of 160,000 and 116,000, which results in 276,000. Now, for motor vehicle, there was an impairment, and we already figured out the depreciation charge for the year as well. So let's have a look above. The depreciation charge per year was 12,000. So let's substitute this amount into our statement. That will be 12,000. And like I said before, whenever there is a case for impairment, we require our ending date accumulated depreciation to be 0. And in order to make that so, we just subtract our accumulated depreciation as well as the depreciation charge, which is 24,000 plus 12,000, which results in 36,000. And after subtracting this amount, our ending date balance is going to be that of 0. Okay, this concludes the second section. Now the third section will deal with our carrying amount, or the net book value. So carrying amount. Again, we need to write down the carrying amount for the opening date and the ending date. We first start with the ending date, so that will be at the date of 31st December 2021, and the opening date is going to be 31st December 2020. We normally write the ending dates. Now, in order to figure out the carrying amount at the ending date, we just need to subtract the accumulated depreciation at the ending date from the cost of ending date. So for building, that is just going to be 750,000 minus 50,000, which results in 700,000. For plant and machinery, that's 624,000 minus 276,000, which results in 348,000. For motor vehicles, that's going to be 18,500 minus 0, which results in 18,500. Now for the beginning date, again we repeat the same process by subtracting this accumulated depreciation at 1st January 2021 from the cost at 1st January 2021. So for building, that is going to be 600,000 minus 150,000, which results in 450,000. For plant and machinery, that is going to be 400,000 minus 160,000, which results in 240,000. Then finally, for motor vehicles, that's going to be 60,000 minus 24,000, which results in 36,000. This concludes the third part. We can now move towards the fourth one. Again, we are given the working section, so make sure that you guys do all of your workings in this particular box so that you get your markings correctly. We are given additional information. The repair and maintenance cost of 30,000 for the 5-year contract for the new machine was paid on 1st March 2021. We now need to advise the directors whether or not X Limited should have entered into the contract. Alright, so we just need to talk about advantages and disadvantages. So let's talk about advantages first. So we entered into the contract for the next 5 years at the fixed amount of 30,000. So this might be an advantage since regardless of any increase in the future cost, we only have to pay 30,000. Let's write it down. Repair and maintenance cost for the coming 5 years is fixed regardless of increase in future cost. And we're also entering into the contract with the same company that we bought the machinery from, which means that the service of the same company for the coming 5 years is guaranteed. Let's write it down. The service of same company for the coming 5 years is guaranteed. Now let's talk about disadvantages as well. We are entering into a 5-year contract, which means that we are paying out this amount of 30,000 at once for the future years. So this basically acts as our prepayment, right? And this one-off payment might adversely affect the cash flow because we could have just paid it as an installment for each different years, right? But we entered into a contract and made the entire payment at once. Let's write it down. A one-off payment may adversely affect the cash flow. And nextly is that this is not a flexible form because if we do not like the service provided by this company, then we cannot change it for the remaining 4 years, right? Maybe there are some other companies providing better or cheaper service, but there is no option for us to go to those service providers. So we can term it as not flexible. Let's write it down. Not flexible, as there may have another company providing better or cheaper service. We now need to make a decision and advise the directors whether or not X Limited should have entered into the contract. And there is no right or wrong answer in these type of questions. So I would just write down that the director should not have entered into the contract just for the fact that this is a one-off payment which adversely affects the cash flows and it is not as flexible. Let's write it down. So the decision is that X Limited should not have entered into the contract. Alright, this concludes the fourth part of this question as well as the entire question number 1 of 2022 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.